Imagine for a second that you run this massive, globally recognized company.
Okay, I'm picturing it.
And for decades, right, you've built up this incredibly complex, highly expensive infrastructure just to create your core product.
Right, a real legacy business.
Exactly. But then, seemingly overnight, this brand new technology drops. It's released to the public, and it allows literally anyone on Earth to generate a near perfect replica of your core product.
Oh, wow.
Yeah. And they can do it for free in like 3 seconds.
I mean, that sounds like the opening scene of a corporate disaster movie. That's the exact kind of technological disruption that, traditionally bankrupts legacy companies in just a few short years.
It really is.
Yeah.
And that is exactly what generative AI has done to the stock photography industry.
Yeah, completely upended it.
I mean, we are sitting here in 2026. Literally anyone with a smartphone could just type a few words and conjure up these hyper-realistic, beautifully lit images right out of thin air.
Just from a text.
Right. So by all conventional logic, a company that is built on actual human-captured photography should be in a state of absolute hair-on-fire panic.
You would think so, yeah.
But yet, we are looking at the financial reality of Getty Images today and the leadership. They aren't panicking.
Not at all.
They aren't even flinching.
Which is wild. The contrast between that external existential threat and their internal confidence on this call is just striking.
It really is.
Kind of forces us to look past that prevailing narrative, the one that says AI just steamrolls every single legacy media business it touches.
Which brings us perfectly to the mission for this deep dive. Today, we are opening up the official source material, which is the transcript of Getty Images' first quarter 2026 earnings conference call.
The real raw data.
Exactly. And for you listening, whether you are, say, a retail investor trying to find the signal in all this noise, or maybe a creator trying to figure out where your whole industry is heading.
Or just someone fascinated by corporate survival tactics.
Right. We are going to decode this really dense, highly technical financial conversation. We're extracting the actual blueprint for how a legacy business builds a moat when the internet's waters are rising.
And when algorithms are shifting and a massive mega merger is just hanging in the balance.
Exactly.
And we are going to rely strictly on the raw data from the transcript to do it. Our goal here isn't to take a victory lap for their management team or write an obituary for the stock photo industry.
No, definitely not.
We need to translate Wall Street accounting mechanics into the actual ground level strategic reality of operating a creative business in 2026.
Because, if you just glance at the headline numbers from this Q1 report, you do not immediately see a confident, thriving company.
You really don't.
You see a business that looks like it is treading water.
Yeah.
And in some places, frankly, taking on water.
Yeah, the surface metrics are rough.
But leadership, CEO Craig Peters and CFO Jen Layden, they are holding the line. They are maintaining their full-year revenue guidance of $948 million to $988 million.
Which shows a ton of conviction.
It does. They sound entirely self-assured. So the immediate glaring question we have to answer is, why are they acting so confident when the surface-level metrics look so, soft?
The answer there really lies in what happens when complex accounting rules kind of violently collide with multi-year licensing deals.
Okay, tell me more about that.
We essentially have to unpack what I call the illusion of the headline numbers.
Right. Let's lay out those numbers first so we know exactly what we're dealing with.
Go for it.
So for the first quarter of 2026, Getty reported revenue of $226.6 million.
Right.
Technically, that is up 1.1% on a reported basis. But when you strip out currency fluctuations, which, is the true measure of the business actually operating.
The constant currency.
Exactly. They are actually down 2.5%.
Ouch.
Yeah. But the number that really jumps off the page is the adjusted EBITDA.
The cash profit.
Right. Essentially, the cash profit from core operations. It came in at $51.6 million, which is a massive 12.2% drop year over year.
That's a huge hit.
And their margins contracted from 31.3% down to 27.2%.
Yeah.
If I'm holding this stock, a 12% plunge in operational cash profit triggers immediate alarm bell.
Oh, absolutely. Any rational investor would see a 12% EBITDA drop and just immediately demand answers.
Right.
But those numbers are heavily, heavily distorted by a specific structural reality in financial reporting. It's known as ASC 606.
Okay, let's stop right there. Because ASC 606 is one of those terms that gets thrown around on earnings calls to sound like super authoritative.
Usually when a CFO wants to wave away a bad quarter.
Exactly.
Yeah.
So walk us through the actual mechanics here. What is this rule and how is it actively distorting Getty's Q1 reality?
So ASC 606 is this fundamental revenue recognition standard, right? It was created by the Financial Accounting Standards Board.
Okay.
Its core purpose is to dictate the exact specific moment a company is legally allowed to record revenue on their income statement.
Got it.
The underlying philosophy is that revenue must be recognized when the transfer of goods or services actually happens, not necessarily when the cash changes hands.
Okay. So it's about matching the financial credit to the actual delivery of the service itself.
Yes, precisely. Now, apply that logic to what happened with Getty late last year.
Okay, what happened?
In the fourth quarter of 2025, Getty secured 2 massive multi-year licensing agreements.
Huge deal.
Massive. But under the mechanics of ASC 606, because of the specific structure of those licenses, which likely involved immediate access to these massive archival data sets, Getty was legally required to recognize roughly $40 million of that contract value instantly.
Instantly in Q4 of 2025.
Instantly in Q4 of 2025. This happens even though the actual terms of the contracts, the duration of the service, stretch out over several years.
Man, it's the equivalent of landing a massive year-end bonus at your job in December. Okay.
That's a great way to put it.
Your December bank statement looks incredible. You feel super wealthy. But then January rolls around and you get your standard regular paycheck.
And you feel broke.
You feel totally broke. Compared to December, January mathematically looks terrible. But the reality is the money is still yours. Your annual earning power hasn't actually decreased. The money just arrived on the balance sheet early.
That bonus analogy perfectly captures the feeling. But let's take it a step further into the corporate mechanics.
Okay.
By pulling that $40 million forward into late 2025, Getty artificially inflated their trailing metrics.
Right.
So when Q1 2026 arrived, it had to be compared against a historical baseline that was essentially pumped full of financial steroids.
That makes a lot of sense.
CFO Jen Layden was very direct about the math here on the call. She explained that this accounting quirk created an incredibly difficult comparable. It effectively dragged down their Q1 revenue growth by approximately 390 basis points.
Wow. And for anyone listening who isn't fluent in Wall Street shorthand, 390 basis points equates to 3.9%.
Right.
So the timing of that $40 million recognition shaved nearly 4 full percentage points off their reported growth for the quarter.
Which fundamentally changes the entire narrative. I mean, if you isolate that $40 million anomaly and just look at the actual underlying operations of the business, the picture flips.
So they aren't actually shrinking.
Not at all. Excluding that pull forward, their 2026 revenue outlook reflects solid structural growth of 0.7% to 4.9% year over year.
So the core engine of the business is still actually expanding.
Exactly.
Okay, I hear the explanation, and the math on the top line revenue makes sense. But let's push back on the profitability side for a second.
Fair enough.
Because a CFO can explain away revenue timing all day long, but money leaving the building is still money leaving the building.
That is true.
And margins plummeted from 31.3% down to 27.2%. That is an absolute canyon in corporate finance. Where specifically is all that cash burning, and how can they promise it will recover?
Yeah, the margin compression is very real, and it's a critical pressure point. The cash burn is tied directly to upfront capital deployment for what management calls tentpole events.
Tentpole events.
Yes. Specifically, the massive, and I mean massive, logistical undertaking of covering the Winter Olympics in Milan.
Okay, so it's essentially the cost of doing business at a global scale.
It's the extreme front-loading of those costs. I mean, to cover an event like the Olympics, you don't just, buy a plane ticket the week before and show up with a camera.
Right, you'd be a little late.
You are spending millions of dollars months in advance. You're securing network infrastructure physically inside the stadiums. You're paying for housing for hundreds of personnel.
Credentialing, advanced equipment staging, all of it.
All of it. You incur massive operational expenses in Q1 to generate the revenue that will eventually follow in the subsequent quarters.
Got it.
Layden stated on the call that because these are front-loaded operational costs, they fully expect margins to normalize back into their historical 30% range as the year progresses, because that's when the revenue from those events actually hits the books.
So the real takeaway for the investor navigating these Q1 numbers is basically to resist the panic reflex.
Exactly. Don't panic.
The headline metrics are a mirage created by a huge Q4 success and massive Q1 preparation costs.
Well said.
But while the aggregate numbers are holding up, the transcript does reveal some severe localized bleeding inside specific departments of the company.
Oh, definitely.
And honestly, the most shocking aspect isn't that they are losing ground in certain areas. It's that leadership is actively, intentionally letting it happen.
Which forces us to look at the agency segment and really the much larger structural collapse happening in the microstock industry.
Okay, let's start with the agency side. The transcript outlines a segment literally called agency, which caters to the traditional advertising firms and creative shops.
The classic ad men.
Right, the folks who have historically been massive consumers of stock imagery. Well, in Q1, revenue from this segment fell by 14% year over year.
A huge drop.
And CEO Craig Peters highlighted that it now represents less than 15% of Getty's total revenue pie.
And you have to understand, the decline of the agency segment is a secular shift. It is not a temporary blip.
It's a permanent change in the weather.
Exactly. Advertising agencies are fundamentally restructuring how they operate. They are bringing more production in-house to protect their own margins.
Sure.
And crucially, they are rapidly integrating generative AI into their daily workflows.
I mean, if an ad agency needs a background image of like a generic coffee shop at sunrise for a client pitch, they're no longer paying a licensing fee for it.
No way. They are prompting an AI to generate it instantly.
And Getty seems to realize that fighting a price war against free and instant is just a losing battle.
It's a race to the bottom.
Right. Peters actually disclosed that they executed a round of targeted layoffs in Q1. They specifically right-sized their sales and service resources dedicated to this agency space.
They see the writing on the wall.
They do. They are reallocating their payroll away from a shrinking customer base.
But the agency pullback is honestly a minor tremor compared to the earthquake happening in their microstock business.
Which is primarily driven by iStock, right?
Yes, iStock. This is where we see one of the most aggressive, counterintuitive strategic decisions in the entire transcript.
Tell me about it.
In June of 2025, Getty deliberately killed the iStock free trial program.
See, this detail completely defies the conventional wisdom of the digital economy.
Totally backwards to what everyone tells you to do.
We are so conditioned to believe that user growth is the holy grail of any online platform. You build the funnel, you offer a free trial, you capture the email address.
And then you boast about your massive active user base to Wall Street.
Right. But by killing that free trial, Getty's active annual subscribers plummeted. They went from 318,000 down to 258,000.
A huge drop.
They willingly, intentionally purged 60,000 users from their ecosystem.
Yep.
It's like a nightclub owner walking outside, looking at a massive line wrapping around the block and telling the bouncers to send everyone home so they can just focus on the VIP room.
That is a brilliant analogy. But take that nightclub analogy a step further.
Okay.
What if the people waiting in that line outside weren't just standing there peaceably?
Oh.
What if they were demanding free samples from the bar, requiring the bouncers to constantly manage them, and leaving negative reviews when they didn't get immediate service, all while never actually spending a dime?
Oh, man. So they were just a massive drag on the business.
That is the digital reality of those 60,000 users.
The server costs, the customer support tickets, the bandwidth overhead.
Exactly. It's expensive to host free users.
Oh.
And Jen Layden broke down the brutal underlying economics of the free trial cohort.
Give me the numbers.
They had renewal rates sitting below 10%.
Wow.
Their overall revenue per subscriber was significantly lower than the historical average, and their customer lifetime value, the LTV, was just atrocious.
So they were basically digital transients.
Basically, yeah. They would sign up, download a handful of generic vectors or stock photos for like a one-off school project or a single blog post.
And then aggressively cancel their subscription before the trial converted to paid.
Oh, got it.
So they were artificially inflating the subscriber count while actively degrading the actual profitability of the platform.
Exactly.
But it's not just about weeding out cheap users, right? The transcript hints at a much deeper infrastructural shift happening on the internet that breaks the traditional microstock business model entirely.
Oh, absolutely. This is the existential threat to mid-tier imagery. The actual plumbing of the internet, like search algorithms, is being rewired.
How so?
Historically, microstock companies relied heavily on SEO and affiliate marketing.
Okay.
So user searches, picture of a dog in a park on Google. An affiliate site ranks highly, the user clicks, gets funneled to iStock, and eventually signs up.
The classic digital marketing funnel.
But that funnel is collapsing. Search engines are rolling out AI overviews and generative answers directly at the top of the search results page.
Oh, right.
So if you search for an image now, the search engine doesn't send you to a third-party affiliate site. It just generates the image for you right there, natively, without you ever leaving the search ecosystem.
Wow. So the top of funnel traffic for generic, low-intent imagery is just evaporating?
Disappearing entirely.
Which makes the decision to kill the free trial not just a cost-saving measure, but honestly a stark acknowledgement of reality.
They're reading the room.
Getty is looking at the bottom tier of the market, all that cheap, generic, easily generated imagery, and they're conceding it entirely to AI.
They're walking away.
Walking away from the vanity metric of total active users to relentlessly optimize for cash flow positive, high-value customers.
Right. And we can see the mathematical justification for this in the data Craig Peters provided during the Q&A.
What did he say?
He highlighted their signature content tier. This is the exclusive, high-quality, heavily curated imagery.
The good stuff.
The very good stuff. That signature segment now accounts for over 70% of their total revenue.
70%.
Yes. And the metrics on these customers are staggering in comparison to the free trial users. A signature customer spends double the amount per year.
Yep.
They generate 3 times the lifetime revenue, and they retain at exponentially higher rates.
So they're trading the illusion of scale for actual measurable profit.
Which is what you want to see.
It sends a very clear signal to institutional investors. This leadership team is not playing games to artificially pump the stock price with hollow subscriber metrics. They are aggressively protecting their margins.
But, as Layden pointed out, this transition is painful to look at on a quarterly basis.
Yeah, I bet.
The mathematical drag from that cancellation is going to linger. Because they axed the program in June of 2025, the year-over-year comparison won't actually normalize until Q3 of 2026.
Because it takes a full year for that free trial cohort to wash out of their trailing 12-month metrics.
Exactly. So for the next quarter or two, the subscriber growth numbers are going to look inherently negative.
It's a calculated purge, but it requires investors to have a strong stomach.
Very strong.
But, this strategy inherently creates a massive pressure test for the company.
How do you mean?
If you are entirely ceding the bottom and middle of your market to free generative AI, you have to replace that volume with something incredibly lucrative.
Right.
I mean, how do you justify maintaining a multi-billion-dollar enterprise valuation when the cheap mass market volume that helped build the company is being automated out of existence?
You justify it by establishing an absolute monopoly on the one thing a predictive algorithm can never mathematically generate.
And what is that?
And this is the core thesis of Getty Images in 2026. They are building their entire defensive moat around unfakeable, verified, human-captured reality.
Wow. And the numbers actually back up this shift in real time.
They do.
While the creative agency revenue was bleeding out 14%, the editorial segment of Getty's business was surging.
Surging is the right word.
Editorial revenue hit $91.7 million for the quarter. That's an 11% increase year over year.
Massive growth.
And Jen Layden highlighted a huge 620 basis point lift in this specific segment, driven entirely by their premium access customers, dramatically shifting their download consumption toward editorial content.
And the underlying catalyst for that massive shift in Q1 was the Milan Cortina Winter Olympics. It perfectly illustrates the limits of artificial intelligence.
Okay, let's break down the mechanics of why that matters.
Sure.
Because a generative AI tool today can create a breathtaking, hyper-realistic, perfectly lit image of a downhill skier.
Oh, easily.
It can put snow on the goggles. It can make the lighting look like, golden hour.
It'll look beautiful.
But what an AI fundamentally cannot do, legally or practically, is generate a real-time, rights-cleared, verified photograph of a specific athlete crossing a specific finish line in Milan, wearing the exact current sponsor logos of the brands, paying millions for that exposure.
Because an AI model is just a prediction engine.
Right.
It is a highly sophisticated probability calculator guessing what pixel should come next based on historical data. It is not a camera.
It has no eyes.
Exactly. It cannot witness an event. So when Visa or Coca-Cola or a major news syndicate needs an image of a gold medal ceremony to push to millions of followers 3 minutes after the anthem plays, they cannot prompt a machine to hallucinate it.
No.
They require absolute verified truth.
And delivering that truth isn't just about handing some guy a nice camera. The logistics required to execute that are staggering.
It's an entire military operation.
Craig Peters explicitly defined this as their ability to deploy at a global scale and deliver content in real time.
Which is incredibly hard.
We are talking about laying physical Ethernet cables in Olympic stadiums, establishing secure, proprietary cloud uplinks, embedding metadata instantly.
Then having an army of editors verifying and clearing the images legally before they ever hit the wire.
That operational infrastructure is the actual moat.
Yes, a nimble tech startup in Silicon Valley can train a brilliant AI model, but they cannot organically spin up a global network of credentialed photojournalists with secure press access to every major sporting and political event on the planet.
And this isn't just a strategy reliant on a single 2-week sporting event either.
Not at all.
Management outlined a very clear pipeline of what they call these tentpole events. They are aggressively preparing for the upcoming FIFA World Cup cycle, and notably the America 250th anniversary.
Oh, the America 250th anniversary is going to be a massive demand catalyst.
Why is that so big?
Because every major corporation, educational publisher, and media network in the world will be running extensive programming and advertising campaigns around the 250th anniversary of the United States.
Oh, right. And where are they going to source the historical imagery for those campaigns?
Exactly.
Where do you find verified, legally cleared photographs of American political history, civil rights movements, or just historical milestones?
You can't just ask Midjourney to do it.
No. You can't ask Midjourney to generate a historically accurate, copyright-free photo of the moon landing or a presidential inauguration that a Fortune 500 company can safely use in a broadcast commercial.
It's too legally risky. You have to go to the Getty archive.
Crucially, Craig Peters emphasized that these tentpole events do not just create isolated spikes in revenue either.
Right. They are acquisition engines. A major brand comes to the platform specifically because they need high-quality coverage of the World Cup. But once they are integrated into the Getty ecosystem, they realize the value of the broader archive.
And it drives downstream demand across the entire platform.
The editorial reality is the hook that secures the long-term subscription.
Okay, I understand the power of the archive and the real-time news desk, but let me play devil's advocate here for a second.
Lay it on me.
If their entire growth engine relies on sports, politics, and historical archives, is Getty essentially abandoning the creative business to become a glorified newswire service?
That's a fair question.
Are they just turning into the Associated Press, but specifically tailored for corporate marketing departments?
It's a very real risk factor to monitor, I'll admit, but the data suggests they're doing something much more sophisticated than just running a newswire.
What are they doing?
They have weaponized the archive as a commercial risk mitigation tool. We have to look at the corporate revenue segment.
Which completely bypasses the traditional ad agencies, right?
Exactly. Corporate revenue grew by 6% in Q1. Why? Because massive brands are terrified of the legal liability associated with generative AI.
Oh, copyright issues.
Huge copyright issues. If a global brand launches a massive campaign using an AI-generated image, and it's later discovered that the AI was trained on copyrighted material without permission, the brand is legally exposed.
So these corporations are coming directly to Getty, skipping the agency middleman entirely, specifically to buy peace of mind.
Yes. They want premium, verified content that comes with an ironclad legal indemnification.
And it's important to note that the purely creative side of the business hasn't vanished entirely either.
Right, it's still there.
Layden noted in the transcript that their Unsplash Plus subscription tier is still experiencing aggressive growth. It's up approximately 20% year over year.
Which proves there is still a highly lucrative market of users willing to pay for meticulously curated, high-end creative photography.
So the creative market isn't dead, it has just been hollowed out in the middle.
The high-end thrives, the low-end is AI, and Getty is abandoning the middle.
Which brings us to the most fascinating and honestly somewhat paradoxical pivot in the entire transcript.
Oh, this is the best part.
We've established that human-captured reality is their impenetrable defense against AI, right?
Yes.
But instead of just retreating behind that wall, Getty is actively weaponizing the very technology that is trying to disrupt them.
They are leaning in.
They are moving aggressively into the AI integration space, and the numbers here are explosive.
We have to look closely at the custom content solutions revenue. Jen Layden casually dropped a metric that should make literally any tech investor sit up.
What was it?
Their custom content solutions, which specifically includes bespoke AI sets and specialized video, surged by over 250% year over year.
250% growth in a single year.
Incredible.
That requires a fundamental explanation of how Getty's AI strategy vastly differs from the rest of the media landscape.
It really does.
Because we've seen other companies, publishers, social networks, they basically take their entire proprietary database of articles or images, accept a massive one-time lump sum check from an AI company, and let the algorithm train on their data.
It's a quick hit of revenue, but it essentially sells the farm.
That is the pure licensing play. But during the Q&A portion of the call, an analyst specifically pressed CEO Craig Peters on this exact dynamic.
Right. He asked to differentiate between one-off licensing deals and recurring integrated AI revenue.
And Peters' response outlines a totally different paradigm. He acknowledged they are executing some limited, direct data licensing deals, most of which will actually hit the balance sheet in the second half of 2026.
But that is not the core strategy.
Right.
The core strategy is integrating the Getty archive natively into large language models and AI search experiences. He explicitly mentioned Perplexity as a primary example.
Okay, let's break down the mechanics of why an AI company like Perplexity desperately needs Getty in the first place. A large language model is essentially a massive predictive brain that has ingested billions of data points from the open internet.
Right.
But the fundamental flaw of an LLM is that it lacks grounded context, it struggles with absolute accuracy, and it has no intrinsic concept of historical truth.
It just guesses words. It frequently hallucinates facts and images.
Exactly. So by integrating directly into these models, Getty is positioning its massive, verified archive as the truth engine sitting physically inside the AI.
That is such a powerful position.
When a user asks an AI search engine for information about a historical event or a current news story, the AI reaches into the Getty database to retrieve a verified, contextually accurate image to ground the response.
It's the classic pick and shovel play during a gold rush.
Yes. Or, more accurately, it's like selling the premium certified flour to the baker rather than trying to build a bakery to compete with them.
They're like that.
Getty knows they cannot stop the global proliferation of LLMs, but they can ensure that whenever an LLM needs to display actual reality, it has to pay a toll to Getty to access it.
And that leads directly into understanding that 250% surge in custom AI sets.
Break that down for me.
This is where the enterprise B2B strategy becomes truly brilliant. We mentioned earlier that global brands want the efficiency and magic of AI generation.
But they are paralyzed by the fear of copyright infringement.
Exactly.
So how does a custom AI set actually solve that fear mechanically? Like, how is it different from a brand just logging into Midjourney?
When a brand uses a public AI tool, the model is drawing upon weights and biases trained on the open, often copyrighted internet.
Wild West.
Total Wild West. The output is a legal minefield. What Getty offers instead is a bespoke, walled garden AI architecture.
Okay.
They go to a Fortune 500 company and say, we will build a custom generative model exclusively for you. We will train it only on our massive database of 100% legally cleared, fully indemnified assets combined with your own proprietary brand assets.
Oh, wow. So the brain gets to type a prompt and instantly generate marketing materials, but they know with absolute certainty that every pixel was derived from legally safe data.
Exactly. It completely removes the legal friction from enterprise AI adoption.
That is brilliant.
Getty isn't just selling images anymore. They're selling legal immunity in the middle of a chaotic technological hurricane.
And that custom infrastructure is a massive, highly scalable growth vector.
It really is.
But, building highly scalable AI infrastructure, running fiber optics through Olympic stadiums, and deploying hundreds of photojournalists globally, none of that comes cheap.
No, it is incredibly capital intensive.
It requires a tremendous amount of upfront capital, which forces us to stop looking at the revenue growth and start looking at the balance sheet.
The dreaded balance sheet.
Because a company can have the most brilliant strategic pivot in the world, but if their balance sheet is a ticking time bomb, the strategy will inevitably collapse.
We have to address the elephant in the room, the debt.
The debt stack at Getty Images is heavy, and it is extremely complex.
Yeah, as of March 31st, 2026, the company's total outstanding debt sits at roughly $1.99 billion.
Nearly $2 billion in debt. For a company that is projecting just under $1 billion in total revenue for the entire year,
It's intense.
that is a massive leverage ratio.
It is a significant burden, and we really have to look at the composition of that debt. The capital structure is highly fragmented.
Break it down.
They have $628 million in 10.5% senior secured notes that are currently sitting in escrow, tied directly to their pending merger.
Oh?
Then they have another tranche of $540 million in notes carrying an 11.25% interest rate.
Double digits. Wow.
On top of that, there is a euro-denominated term loan of approximately $481 million.
So the blended interest rate across all these instruments has to be punishing.
It is. Management estimates their cash interest expense for 2026 will be a staggering $194 million.
Nearly $200 million in pure cash walking out the door every single year just to service the interest.
Before they even think about paying down the principal.
Or investing in new technology. That means the core operations have to run flawlessly just to feed the debt machine.
That level of interest expense is a severe drain on liquidity. However, the Q1 transcript does offer a silver lining regarding their ability to manage it.
Good, we had some good news.
We have to look at their free cash flow. For a highly leveraged company, free cash flow is oxygen.
Absolutely.
In Q1, their free cash flow improved dramatically to $24 million.
Okay. Now, in a vacuum, $24 million might not sound like a massive cushion against $2 billion in debt.
Right.
But you have to compare it to their reality just 1 year ago. In Q1 of 2025, their free cash flow was negative $300,000.
Oh, wow. Going from bleeding cash to generating $24 million in a single quarter is a massive operational turnaround.
It is. But it begs the question, why was the cash flow so severely depressed in 2025 in the first place?
Well, CFO Jen Layden dedicated a significant portion of her remarks to providing context for that exact cash burn.
What did she say?
She detailed how, since the beginning of 2025, Getty has been hammered by an avalanche of what she categorized as one-time expenses.
Let me guess.
Over the past 15 months, nearly $115 million in pure cash evaporated to cover anomalous events.
Right. Let's break down where that $115 million actually went.
Right.
Because one-time expenses is another one of those terms management loves to use to excuse bad cash quarters.
True, but the breakdown here is quite literal and legally binding.
Okay.
The cash was consumed by massive legal and consulting fees related to their pending mega merger.
Makes sense.
It was drained by aggressive, ongoing AI-related litigation to protect their copyright borders. There were heavy compliance costs associated with Sarbanes-Oxley or SOX requirements.
Standard public company stuff, but still expensive.
But the most devastating blow was a massive $110.9 million cash payout required to settle the ALT-CRCM warrant litigation.
Oh, that warrant litigation was a brutal hit. I actually recall reading the filings. They actually had to tap their revolving credit facility for $120 million just to satisfy the judgment and ensure liquidity.
Although they did eventually claw back about $30 million from their insurance carriers.
Sure, but regardless of the insurance, suffering $115 million in one-off cash burns while simultaneously trying to service $200 million in annual interest.
It's brutal.
It is a financial stress test of the highest order.
It is. But Layden's core message to Wall Street during this call was that the gauntlet has been run.
It's over.
She stated unequivocally that the material nature of these massive anomalous expenses is largely behind them.
Okay.
The legal judgments are paid, the integration planning is funded, they project a return to the robust, normalized levels of free cash flow generation that historically characterize the business.
So the financial house is finally being swept clean.
Basically, yes.
The one-off legal bills are settled, and the core cash flow engine is turning back on.
Exactly.
But there is one massive, unresolved variable hanging over this entire balance sheet.
Yeah.
And it is the reason all those senior notes are currently trapped in escrow.
The Shutterstock merger.
Yes.
The proposed merger between Getty and Shutterstock would completely, fundamentally reorder the global landscape of visual media.
Combining two of the absolute largest players in the space into a single monolithic entity.
Craig Peters provided an update on the regulatory progress here, and honestly, it serves as an incredibly frustrating, real-time case study in the modern realities of global antitrust enforcement.
I have to admit, reading this specific section of the Q&A felt almost absurd.
It's Kafkaesque.
The sheer scale of the bureaucratic bottleneck is mind-bending. The transaction to merge these two companies has been unconditionally cleared by regulatory bodies in virtually every jurisdiction globally.
The United States, the European Union cleared.
Cleared, except for one solitary holdout, the United Kingdom's Competition and Markets Authority, the CMA.
They are single-handedly stalling a multi-billion-dollar global mega merger.
And the reason why is almost comical.
It highlights how hyper-local regulatory bodies can hold global commerce hostage.
Craig Peters sounded palpably frustrated on the call when detailing the CMA's objection.
The UK CMA initiated an in-depth investigation based on a significant lessening of competition, or SLC theory. But the specific isolated segment of Shutterstock's UK business that the CMA is actually concerned about represents a grand total of just £3.5 million in annual revenue.
Let's just pause and process the math on that.
It's crazy.
You have a combined global entity that will generate in the neighborhood of $2 billion in annual revenue.
Yes.
And a sovereign regulator is halting the entire global integration process over a subsegment of the market worth £3.5 million.
Which is literally a rounding error on their balance sheet.
How is that even legally justifiable?
Well, in the realm of antitrust law, regulators like the CMA don't always look at the aggregate global revenue. They look at highly specific, localized market concentrations.
Okay, so give me an example.
Their argument is likely that within a very specific niche, say UK-based broadcast news licensing the merger of Getty and Shutterstock would eliminate the primary alternative for buyers.
So they fear a monopoly in that tiny niche.
Right, leading to price gouging, regardless of how small that specific niche's revenue is relative to the global pie.
It's the very definition of missing the forest for a single tree. But it has massive implications for the stock.
Huge implications. Peters made it clear that Getty firmly believes in the long-term value creation of the merger, and they are actively engaging with the CMA to resolve the SLC finding.
And they have a hard deadline, right?
Yes. The CMA is legally required to issue its final decision by June 14th.
Which makes June 14th, 2026, the ultimate catalyst date for anyone tracking this company.
Circle it on your calendar.
By mid-June, Getty will know if they have to carve out and divest a tiny fraction of their UK operations to appease the regulators, or if the entire global deal is blocked.
That decision will either unlock hundreds of millions of dollars currently trapped in escrow and allow the synergies to begin, or it will force them back to square one.
It is a massive binary event. But, even with that uncertainty looming, the Q1 call paints a remarkably clear picture of Getty's trajectory.
It really does.
If we pull the lens all the way back and synthesize everything we've decoded today, the accounting quirks, the strategic purges, the Olympic logistics, the AI integration, and the debt management, what is the ultimate story of Getty Images in early 2026?
The story is one of a legacy company executing a deeply painful but highly disciplined evolution.
They're refusing to play the vanity metrics game.
Exactly. They willingly slaughtered their free trial program. They're letting their legacy agency business shrink.
They're absorbing the short-term margin hits from massive capital deployments.
They're taking the localized pain today to build an impenetrable fortress for tomorrow.
They're looking at a future where generative AI can create infinite amounts of generic content, and they are doubling down on the one asset AI cannot compute.
Exclusive, rights-cleared, verified human truth.
The America 250th anniversary.
Yeah.
The World Cup. The Olympics.
And simultaneously, they're executing a brilliant B2B strategy, selling the truth engine context and the legally indemnified walled garden models that the massive AI companies and Fortune 500 brands desperately need to operate safely.
It truly is a masterclass in identifying and fortifying a corporate moat during a period of unprecedented technological disruption.
Which leaves us with a fascinating macro-level question to consider as we watch the generative AI revolution mature over the next few years.
What's the final thought you are leaving us with?
Think about the fundamental laws of supply and demand. As generative AI continues to flood the internet, social media, and search engines with billions upon billions of synthetic, frictionless, perfectly lit, hallucinated images, the supply of fake is becoming truly mathematically infinite.
Infinite fake images.
Infinite.
Yeah.
But the supply of verified, human-captured reality, actual historical events, actual sports outcomes, actual photojournalism remains strictly finite.
You cannot algorithmically generate more real history.
You cannot. So over the next decade, as the digital world becomes increasingly synthetic, will Getty's historical archive and real-world editorial network stop being viewed by Wall Street as simply a media content library?
And start being valued as the internet's ultimate, irreplaceable infrastructure for proof of reality.
Exactly.
The internet's ultimate proof of reality. If institutional investors and algorithmic trading models begin valuing Getty not as a legacy stock photo marketplace, but as a critical infrastructure play for verified truth,
It fundamentally alters the valuation multiple of the entire company.
that is an incredibly profound concept to mull over. We want to thank you for joining us on this deep dive into the sources today.
It's been a great conversation.
Whether you are actively evaluating the stock, monitoring the pending merger, or just watching the AI revolution reshape the global economy, remember to always look past the headline numbers.
Always.
Keep questioning the accounting mechanics, dig deeply into the transcripts, and always look for the actual structural story operating beneath the surface. We will catch you next time.